Thanks so much for this kind introduction. I'm very happy to be virtually present in this workshop. Lots of interesting stuff. And what I'm going to present on today is based on our recent paper that we wrote with my colleagues, Jai Li and Shao Zhang. The paper is published in Risk magazine, but also the open version is available on arXiv. And I also, do you see my cursor here? Yes or no?
Yes? Yeah, okay, we can see it.
Yes, all right. So the second paper is actually these two papers, why I mentioned them together, because they share lots of mathematical formalism in what comes specifically to the reinforcement learning part of it. So the background of the talk is shown here. So first I want to talk about how problems of asset management or portfolio management are all problems of high-dimensional stochastic optimal control, or alternatively or equivalently problems of reinforcement learning. And then I present a particular version of reinforcement learning called G-learning, which is essentially entropy regularized P-learning as applied to these problems, and show you specific and straightforward mathematical approach to solve the direct reinforcement learning problem for fund managers. And then I will talk about the inverse of this problem, which is called inverse reinforcement learning, and show you how we can use that within the same model for direct reinforcement learning to back up reward functions of fund managers. And all in total, the talk will be about combining these two things, direct reinforcement learning and inverse reinforcement learning, in one overall scheme, which basically there are multiple ways to interpret this, but my favorite way is to say that this is actually one simple way to combine human and artificial intelligence in a very straightforward way, right? Where everything is under your complete control. All right, so let me start maybe with a brief reminder of what reinforcement learning is. And it's summarized briefly in this scheme. So first of all, reinforcement learning is a branch, as many of you know, probably by now, is a branch of machine learning, which deals with sequential decision-making, which extends over multiple steps, where at each step, the same sequence of interactions happens between an agent, which is shown here on the left, and the environment. So at each point in time, the agent receives some information from the environment encoded in this possibly high-dimensional state vector S sub t, and then it acts upon receiving this information. It acts on the environment, exercises some actions, and as a result, it receives a reward. So the ultimate goal of the agent is to maximize this total reward, and the reward is a measure of happiness, if you wish. But mathematically, rewards are just functions of the state and action statement. All right, so what I'm going to present today is a version, as I mentioned, is a version of reinforcement learning called G-learning, and show how it can be applied to problems of asset allocation. And then after that, I will talk about two ways to do inverse reinforcement learning in the same setting. All right, so please interrupt me at any point in time if there are any questions. Well, I usually don't put that many equations in my slides, but given that it's a presentation at Fields Institute, I got excited and put many. But let's see how it goes. In any case, if you get lost at some point, it's not a big deal, because all of this math is presented in our papers and also in the book. So you can always go back and check that. All right, but in short, what we deal here with is the following things. So first of all, we have a universe of n assets, and we can think of them as stocks, but it can be anything. It can be actually, in my formulation, it will be buckets of stocks. but I'll talk about it shortly. So the vector P will denote the market prices of these instruments, and these are risky instruments, so they have risky returns. And we also can have one risk-free asset, which can be thought as a risk-free bank account, which pays risk-free interest rate RF. And my state variables will be encoded in this vector x sub t, which has dimension n, and it describes dollar amounts of all positions of all assets in the portfolio. So negative values mean short positions. Finally, trading has costs, so market impact does not really belong here. So we will be mostly focused on this part of trades, and finally, trades themselves are encoded in a vector ut, which has the same dimension, and all trades are thought as made at the beginning of time interval t to t plus delta t. So it's a discrete time formulation. Now, reinforcement learning starts where we define a reward function, and that's actually the key part here, absolutely critical for everything that we do. Our objective for these papers was to come up with the simplest possible and intuitive model for the reward function, which would also be quadratic in its variables. So here I show you a particular reward function model that we use here. CT is the cash flow, which goes into portfolio at this time step. And the reward function has this simple form. So what it has here, we have three terms. All of them are very intuitive. So the first term is the thickest one. So what it describes, we visualize our portfolio and our objective as matching some sort of a target portfolio, which I denote here as Phat. So this is known to me at time t, right? And what I'm trying to do, given my states xt at time t, I want to do trades. So instantaneously, my dollar positions at the beginning of time interval change to this quantity, but then by the end of the interval, it grows randomly with a stochastic return RT. So this whole term is the quadratic penalty for underperformance relative to this benchmark, and I'll show you shortly what we use for this Phat. But for now, let me tell you about these other terms. So they are pretty straightforward. The second term, basically, in the first version, we just had a hard constraint. But for this formulation, we use soft constraint. So basically, this is the total trade made at time t, and this is the cash flow, right? So if you think of
Igor,
yes?
there is a question. Do you want to take it now, or you want to wait till the end? Tarun, do you want to unmute yourself?
Yes. Igor, what is ut? Is it xt minus 1, or how do you define ut?
Not really, because in this notation, xt plus 1 will be this whole expression. So ut is the instantaneous change of your dollar value position. So it's just the trade. So we map all the trades. So we proceed in discrete time, and now time steps are actually 1 month. So right. We project all trades which are done in this month at the beginning of this interval.
Okay.
All right. So coming back here, as I said, this term is just the soft constraint for total trades. So this is total trades. This is money flow to the fund. And if you think of limit lambda goes to infinity, then it becomes hard constraint. And finally, the last term is just a simple and popular transaction cost model, which is taken to be quadratic here. All right, so omega is, we can think of omega as a matrix, but actually we just collapse everything into just one number. So we parameterize this whole matrix as one number. All right. So this is my reward function, and as we said, the traits here serve as action variables, and the dollar values of positions serve as state variables. Now, what is very important here is what I already mentioned, that actually once we expand this expression, and I'll show you shortly in the next slide what it gives, but you can already guess that this whole thing is quadratic in states and action variables, and this is critical for this formulation. Now, let me talk about what we use here as this p hat. So p hat was designed to be some sort of a running goal, which is related to your current portfolio. And this is what makes it running goal. And the expression for this target portfolio is given here. So what is what? Here, BT is some sort of a portfolio independent benchmark. So you can think of, a benchmark for fund index as this BT, but expressed in dollar terms. All right, and they also rescaled to match the initial value of the portfolio, but it's essentially an index, right? So to form this p hat, we take a mixture of this index, benchmark index, and your current portfolio, and we mix them using these coefficients. So rho and eta, here are three parameters. So eta has the interpretation of how much you expect your portfolio to grow. Basically, and rho is like how much your target is correlated with your benchmark. All right. Okay. So now parameters also. Maybe I have to go back here a little bit. So this is quadratic reward, right? And quadratic penalties or quadratic rewards are known for. On one hand, they are very analytically tractable. On the other hand, they are known to penalize both, underperformance and overperformance, which is not what we want to do. But an easy practical way to handle this is just to set parameters and put these parameters such that you kind of have no chance of overperform. So your running goal is always above you, pretty far away. Just the motivation to trade towards that, right? So this is how we address this question. Now this is what I mentioned before. So we want to evaluate this whole expression, right? So you see that it has expectation taken at time t of this thing. This guy is rented here, right? So what we do, as usual, we decompose it into the expected returns plus the noise, right? Because we include risk-free asset, then we write this noise in this form as a block matrix, which has zero element and covariance of these two assets here, right? And if you do math, you expand this expression, you will see like a more compact expression here, which we also can rewrite explicitly as shown here, some quadratic form of your states and actions with coefficients are x, etc., which are all computed in terms of these origin parameters. And this matrix sigma hat defined as here. So all in total, what we have here is a very, very simple reward function, which only has 4 parameters, which are all described here. Now, maybe one more thing I need to mention here. Usually people put parameters such as lambda, which is usually identified with risk, here, and we could do this here as well. But what I show here is some sort of general rescaling of this whole expression. We just rescale it to have the parameter here to be 1 for convenience. All right. Okay, so this is my reward function. As I said, it has only 4 parameters, and it turns out that because of this specific design, this whole formulation gives rise to a semi-analytical reinforcement learning. So this version of RL does not have any neural nets, so any deep neural nets. The whole formulation is semi-analytically tractable, which means that it uses just a bunch of linear algebra and nothing else. All right. Now, the other thing is that what we use is another difference of this approach from more conventional dynamic programming approaches is that we use stochastic policies, right? And the motivations, there are multiple motivations for using stochastic policies. One of them is mentioned here, right? So even if we stick to deterministic policies, for example, that's what we do in Markowitz portfolio model, then nevertheless, when we estimate parameters of these models, because they're estimated from data, essentially they become random, and therefore your de facto your policy will also be random, right? So there is another way to recognize this uncertainty in the uncertain world and directly formulate your policies as stochastic. And there are multiple advantages of doing things this way. All right, so in this sense, we can talk about stochastic policies, which can be any valid probability distributions of the action variable conditional on the state variable. And in addition, it will be also dependent on our expected returns. Right, so I mentioned multiple advantages. One of them of this formulation, one of them is mentioned here, is that if we have stochastic policies, then it means that we have a generative model for our action, and therefore can be used for simulations. All right, now the formulation of the enforcement learning in this stochastic policies is as shown here. So basically what we want is to maximize the expectation value of future reward discounted by some discount factor over trajectories which are induced, as shown. This is the expression for path trajectories, and they would be induced by the transition dynamics of your system and also by your policy. So we maximize this expression for the deterministic policies. We maximize the respective actions. But for stochastic policies, we maximize this whole thing with respect to distributions of action, with respect to policies. All right. The other thing which is a building block here is we have a concept of a reference policy, which we may also call prior policy. So this is something that we, either have in mind as a prior model of action before seeing any data, or maybe this is something based on our previous experience or previous training, etc. Right, so we will be using a simple Gaussian prior policy, which is shown here, where this A hat is actually, so this is the mean of the Gaussian policy. It's a linear function of our state. Okay. Now this is the most famous equation of dynamic programming, which is shown here. Well, actually, it's already written here in the form which is suitable for stochastic policies. So the optimal value function, which is shown here, is usually denoted as V star, is obtained by maximization of the expected total reward over, here shows this maximization of over policies. But again, like for a special case of this, it would be equivalent to maximization over actions themselves. All right, and now, okay, so this is the definition. Sorry, and the most famous equation is shown in the next slide. So this is the equation which is called Bellman optimality equation, which is a recursive relation for which relates the optimal value function at time t with its expected future value at the next time step and the current reward. So to get this star, so maximization of this implies that we maximize over actions here, right? Now this is this transition which allows you to move from the standard case of deterministic policies, as implied here, to the stochastic policies which we use. The cases, the transition is shown here. So we can start with this equation, which maximizes over actions, and rewrite it as maximization over all valid probability distributions, right? And if you just do that, because of this property that the maximum over some set of elements xi is the same as maximum of this expression over valid probability distribution. So far, this is just identity, right? However, we can bring some sort of regularization to this identity, and then it will become a different approach with truly stochastic policies. And the way we do this, this was first proposed in this paper by Naftali Tishby with co-workers in 2015, who came up with G-learning. And so this part of math is taken from there. What they do, they say that we need to introduce the so-called information cost of a learning policy relative to the reference policy pi naught, which is defined by this expression. And if you take the expectation of this expression over the policy, then you will just end up with a KL divergence of your policy, right? So then this gives you a KL divergence for time step t, and if you take the sum of the expectation of these expectation values and discount them, it will give you the total discounted information cost for a trajectory. And on the next step, you use it as a regularization. So basically, we take the value function v, and we add to this regularization with some coefficient which is denoted as 1 over beta, and this thing is called the free energy, borrowing the term from physics. Right, so this is the definition. We can alternatively write it in this form, and what we will notice is that this parameter, as always with regularization, controls the degree of regularization. So if you take beta to infinity, then this drops out, and then we will be back to deterministic policies. But that's not necessarily what we want to do. Now, if you take this definition, then you can redo the working of the Bellman equation and come up with the Bellman equation, the version of Bellman equation for this object, free energy, which is shown here. So it takes the same form as the original Bellman equation, but it has this additional term in the reward. So you can think of this as an entropy regularized reward, and about the whole expression as a soft probabilistic relaxation of the Bellman optimality equation. All right. Now we need another element, which is entropy regularized version of the Q function, and it's denoted in G-learning as G function. So it's the same way. So relation between them is the same as between Q function and value function in reinforcement learning. It's the expectation of the same expression, however, conditioned on both current state and the first action taken. So there is this expectation here. All right, and then by looking at this definition, we can work out the relation between this free energy function and the G function, which is shown here. Right. So now it makes the objective of finding the policy. Once we know, if we know the G function, we just have to maximize this whole expression. All right, and this is done analytically. So the result is shown here. And for those of you who are familiar with maximum entropy methods, this is very conventional expression. So the optimal policy is just the rescaled to maintain normalization product of your prior policy and the exponential factor, which has the G function in exponent. And the normalization constant is shown here. It's also known as partition function in physics. All right. So if we now substitute this optimal policy back into this expression, then we will find that the free energy is given by this expression, and it's actually related to the log of this normalization function, which allows us to rewrite the expression for the optimal policy in this nice way, which now contains three functions. So it contains the optimal policy, it contains the g function and f function. And if we put it all together, we end up with the system of three equations for these functions, g, f, and pi, which have to be solved self-consistently. And if we have a time-dependent problem, which is the case here, then these self-consistent equations have to be solved for each time step, starting from the terminal time, where we have terminal conditions which are shown schematically here. So we have a terminal condition for G and for F. And all right, and then using, I already showed this formula. So the key element which allows analytical treatment here is our reliance on Gaussian policies. And we start with the Gaussian prior, which is again shown here. And if we do that, and we use quadratic reward, so these are general equations for G-learning, right? So they are true for any model. If you're brave enough, you can use them with deep neural nets, but that's not what we wanted to do. We wanted to find a simple semi-analytical solution of this, and this is indeed achievable. As I mentioned, if your rewards are quadratic and your prior distributions, policy is Gaussian. Okay, and so how it works out? We just postulate and then prove ourselves correct, and that the true value function for this problem is a quadratic form of your state. So, right, so the value function or the free energy is a function of the state, and this is the form that we impose, where this would be coefficients which may depend on time through their dependence on the target portfolio and expected returns. And then what we do, we just have to use this expression and plug it back into the Bellman equation and compute this expectation that I showed you there in the right-hand side. And to compute this expression, we need the dynamic equations, which take this form. So it's a instantaneous change, sometimes some matrix, which is made out of expected returns. So it's a brief term. And there is also the noise term, right? So if we put it all together, then we will have a recursive relation for coefficients in this form. All right, and we solve these recursive equations starting from the last interval, last period. So in the last period, we have boundary conditions, we have terminal conditions, which I showed you before, and this allows you to take to perform the first step. If we go backward analytically, the analytical result for the action is given here, right? And then we just start rolling it over. All right. So all the math is given in our papers and also in the book. The interesting fact, which could also be anticipated, is because our functions are all quadratic, our prior is quadratic. It means that once we started with the Gaussian prior, we also end up with the Gaussian optimal policy. And this update is shown here. So basically, we have the same functional form of the optimal policy, where it's Gaussian, right? So the mean is again a linear function of the state, but the coefficients are now intercept and the slope are now new and updated, and they depend on the action value function and input function. All right. So there is again repeated here. Okay, so the full scheme is summarized here. So we actually we don't need this initialization. We just go to maturity, so to the terminal time. We start with the terminal conditions, and then we, starting from the previous time, we compute the expectation value of the future value function. Then we use it to compute the Q function, and then we use this Q function to update and compute the value of the value function for this current step, and then we roll over. And during this, we also update the policy distribution. All right. So this is in brief. Details can be found in the book and in the paper again. And in the first paper, which we wrote with Matthew, we also have some examples which are obtained with synthetic data. This first paper was more focused on retail investors in a simulated world, but this current presentation is mostly focused on fund managers and influence of their action, and my numerical examples will focus on that. All right, now I want to talk a little bit about the inverse reinforcement learning formulation. So all this scheme was about direct reinforcement learning, when you basically observe rewards which were obtained by an agent. And what you have to do, you have to use these rewards and optimize policy. This is the standard formulation of direct reinforcement learning. But there is even more interesting twist of this called inverse reinforcement learning. And this happens, this situation happens when you have an agent and you observe actions of this agent in given states of the world, but you did not observe rewards. And actually, your problem would be to explain the behavior that you observe in terms of rewards that that you make inference for. So in the current model formulation, the inverse reinforcement learning is pretty easy because it amounts simply to maximum likelihood estimation within the same model. And we just have to, so the likelihood of the data, the log likelihood of the data is shown here. We may throw away this part because it doesn't depend on parameters of the rewards. But once we minimize this expression with respect to parameters, then essentially what we achieve is backing up the reward function. And clearly this can be done very easily. The problem is low dimensional, right? So you can use gradient descent or stochastic gradient descent. Ended up with the algorithm that we called in our paper is we call it GORL, which stands for G-learning for IRL. So this is what we did in and this GORL actually belongs to a wider class of inverse reinforcement problems, which are called maximum entropy inverse reinforcement learning. Now, it's a pretty popular approach, but it turns out that it makes pretty drastic assumptions, which are not necessarily valid assumptions for financial applications. Namely, the assumption that it makes is that what we saw is already optimal behavior, right? So, which means that it doesn't mean that necessarily each individual action should be optimal, but it should be optimal in a statistical sense, right? So you observe behavior and you believe that this behavior is obtained from optimal poles. But in finance, we don't always know what is optimal, right? So this notion simply does not exist. So it might be a bit risky to assume that everything that we observe, behavior of individual fund managers is optimal. And therefore we decided to use another pretty cool algorithm for inverse reinforcement learning, which is called TREX, which stands for Trajectory Ranked Reward Extrapolation. which was proposed by researchers from Washington University, Washington State University, I believe, Brown and co-workers. The idea there is that why it's called reward extrapolation, the idea here is that actually it goes away without assuming that everything that you saw was optimal. What it tries instead is to capture the intent of the agent rather than the actual results. And the way it does it is pretty straightforward. So it operates at the level of preference relations, which are shown as here. So if we say tau I is less than tau j, it means that trajectory j is preferred to trajectory I. And the model, the way to find the reward function, so let me remind you that here this algorithm is general, but in this work we have the same model for the reward that I just showed you before, and all that we discuss here is how to back up parameters. So what we say is that the reward function should be such that it should satisfy these preference relations for the total rewards obtained over the trajectory. So if I know, for example, that rewards for one manager were sorry, if I know that returns, so basically we align everything with the ultimate performance of funds and stocks. And if I know that returns for the portfolio of one manager were higher than returns of portfolio of another manager within my time horizon, then I translate it into a statement that the cumulative reward for the second manager was higher than cumulative reward for the first manager. All right, and obviously this relation depends on the parameters that I use for my reward function. But given these parameters, what we do, we simply train the binary classifier, saying that the difference in performance for fund should translate into this preference relation for rewards. Sorry for that. All right, so the final loss function is just the cross entropy loss, which is shown here. Now, as I said, the big deal about this T-Rex algorithm is that it tries not to just mimic what it saw, but because it captures this intent, it's able to, in theory at least, to surpass the picture. And I'll show you some evidence that it's indeed possible, but before that, I'll show you the final flow chart of our scheme. So we take the state action observations, which actually is just pairs of positions and traits. We rank them according to the performance of a fund over some period of time. And we measure this either in terms of cumulative rewards or in terms of Sharpe ratio. In the paper, we chose total reward as a metric. And we use this T-Rex algorithm to back up parameters of the reward function. And then we pass this reward function to our direct reinforcement learning algorithm to get the optimal policy. All right, now to the results. All these results are collected in our paper, which also has a little more graphs, which I don't show here. But first, starting with, so what we did, we had a group of funds, few groups of funds, actually, one group which has the S&P 500 as a benchmark, and another group of funds which was further divided into two subgroups, which have Russell 1000 as a benchmark, which we, and this second group we divided further into growth and value funds. right? So in total, we have three subgroups of funds, and we use their benchmark as this benchmark B that I mentioned before. Right. Now we train our IRL model, T-Rex, and these graphs show convergence of different parameters. So remember that we have 4 parameters, and they all nicely converge to something, which, as we hope, make intuitive sense, even in terms of differences between, some differences between 4 parameters. So parameters are shown here, but another test that we did here, we also is shown here. So what we do here, it's a validation of our IRL step. So because our IRL is a classifier, we can check this classifier both in sample for accuracy and out of sample. And we also can check the correlation between our predicted, so our actual reward and predicted reward. And these graphs show that actually it works pretty well, so numbers are really close here, which gives support for our reward function. And I'm almost done. How many minutes I have left? I think none, right?
We are about time already, but you can wrap it up.
Okay. Yeah, it's almost the last slide. So
Sure.
the last slide shows so this is the most juicy part, I would say, because this last slide, what it shows here, we plot here over performance. So that's the difference between what our model spits out and what actually was observed in the data. Also, by the way, I forgot to mention a very important detail that we did dimension reduction here. So we can operate at the level of stocks. We collapsed everything onto sector exposures. So our portfolio is effectively a portfolio of 11 assets, right? And our expected returns are returns obtained from a quant model aggregated to the sector level, right? So the whole thing can be thought as some sort of a debiasing versus, potential bias regarding sector exposure. And what we show here is overperformance of our model relative to the average performance in the training set for these three groups of funds, which gives us the red curve. So if the red is in the positive domain, it's a good thing. So which means that we win. And another curve is the green one, which is the performance in the test data set. So this looks pretty plausible. This does not look very plausible to us, but we suspect that it was because of the regime in our test data set was a little different from the regime. So this is like almost too good to be true, because here the test performs even better than the trade. All right, so I'm almost done. That's my summary. So this proposed framework amounts to a two-step procedure. We first use IRL to infer the reward function, and then we use IRL to optimize asset allocation. As I mentioned, it can be viewed as a way to combine natural and artificial intelligence, or maybe as a way to leverage on collective intelligence of individual fund managers and outperform most of them. Not all of them, but most of them. It can be used as for trade recommendations. For this thing, we would need to go down from the level of allocations at the sector level to the recommendations at the stock level. It can be used for fund analysis as well, and it can also be extended along multiple ways. For example, by choosing different way to do dimensional reduction. You can do the same thing, for example, using factor-based approach. I would like to stop here and take questions. Thank you.